Hello, and welcome to our webinar on the annual improvements to IFRSs for the 2015 to 2017 cycle. Some of you might not be familiar with the annual improvements project. The annual improvements are a regular feature in the ISB's work program, which allows the ISB with a mechanism for dealing efficiently with a collection of minor amendments to standards. Generally speaking, every single change to the standards of IFRS require a due process to be followed. But there are some changes that, whilst they're required, are not necessarily urgent, and therefore they don't need to go through a dedicated due process with exposure, comment periods, and so on. The annual improvements allows all of these relatively minor changes to be dealt with collectively, almost as an omnibus of amendments. Every annual improvement project effectively amends various standards. In the present cycle that we're looking at in this webinar, we're looking at amendments to IFRS 3 on business combinations, IFRS 11 on joint arrangements, and IS 12 income taxes, and IS 23 borrowing costs. There are some parallels. For example, IFRS 3 and the amendments to IFRS 3 and IFRS 11 deal with similar issues, but they are separate amendments, whereas IS 12 and IS 23's amendments have nothing to do with each other, but were dealt with collectively as part of this project of amendments in the 2015 to 2017 cycle. Let's start with the first amendment, being that to IFRS 3 on business combinations. In order to understand the issue that has been fixed with the amendments to IFRS 3, let's take a moment to look at two scenarios and see what the existing accounting was prior to the amendments that have been made. In the scenarios, we've got Alpha, who owns 25% of Beta. It accounts for Beta as an associate using the equity method of accounting prescribed under IS 28. In the current year, Alpha purchases an additional 40% of Beta. How should Alpha account for this transaction? I'll carry on to the second example, and then we can look at the issue together. Gamma owns 5% of Amiga. Amiga is accounted for at fair value through other comprehensive income under IFRS 9. In the current year, Gamma purchases an additional 70% of Amiga. Once again, how should Gamma account for this transaction? Now, in both of these scenarios, we have an investor who's obtained control of an investee, an acquiree, using the terminology under IFRS 3. Both Alpha and Gamma obtain control of the businesses that they've now purchased an additional stake in. But in both scenarios, the acquirers have previously accounted for a previously held stake. In the first scenario, it was an investment in an associate, which was being equity accounted. And in the second scenario, the investor had a financial asset, which was being accounted for as such under IFRS 9. The existing guidance under IFRS 3, not the subject of the amendment that we're going to discuss in just a moment, but the existing guidance says that in applying the acquisition method of accounting, that's what this slide illustrates, the acquisition method of accounting requires the acquirer to include, as part of the calculation of goodwill or a bargain purchase gain, whichever way the numbers fall, to include the fair value of any previously held interest in the acquiree. What that means is that any previously held interest in the business that has now been acquired, in which control has now been achieved, any previously held interest is accounted for at fair value, or rather remeasured to fair value, and any gain or loss between the remeasured fair value at the acquisition date and the previously held carrying amount up to that point is recognized either in profit or loss or in other comprehensive income, depending on how the gain or loss would have been recognized had an outright disposal taken place. In effect, what IFRS 3 is saying is, if I'm acquiring control of a business and I had a previously held interest, I've effectively disposed of that previously held interest, and I recognize a gain or loss on that deemed disposal. And I now, in giving up the previously held interest, I'm now getting the assets and liabilities that I've obtained control of as part of the business. If the gain or loss would have been recognized previously in other comprehensive income, likewise the gain or loss would be dealt with in other comprehensive income, as would be the case for an outright disposal. So in effect, we apply whichever standard applies to the investment up to the point where control is obtained, whether that's a financial asset under IFRS 9 or an investment in associate under IAS 28 or a joint arrangement in terms of IFRS 11, we apply the appropriate accounting up to the point where control is obtained. At that point, the nature of the investment changes and we go from equity accounting or fair value accounting to consolidation. And at the point where control is obtained, the previously held interest is effectively disposed of and a gain or loss is recognized. So that would be the effect then in the two scenarios that we discussed a moment ago. Alpha would take the fair value of the previously held 25%, compare that to the 25% that had been equity accounted, recognize a gain or loss, and apply the rest of the acquisition method of IFRS 3. Gamma would likewise do the same. However, in Gamma's case, we have a slightly different scenario in that by accounting for the 5% at fair value through other comprehensive income, which is an election that's available under IFRS 9, the gain or loss that might be recognized, or any cumulative gain or loss that might have been recognized through that fair value accounting, remains in equity because IFRS 9 does not permit a recycling of gains or losses back into profit or loss on disposal of such an investment. Let's look at one further example. In this third scenario, we have a company called Delta that owns 33% of a joint operation called Vega. Delta is accounting for the investment under IFRS 11, which is the standard on joint arrangements, and now purchases an additional 33% of Vega in the current year. How should Delta account for this transaction? In order to understand the implications of this scenario, let's turn briefly to IFRS 11. We'll come back to IFRS 11 in just a moment when we discuss the changes made there, also as part of the annual improvements project. But for us to understand the implications of the Delta scenario, let's look at what the accounting requirements of IFRS 11 are to understand the issue and what has now been amended as part of the changes made to IFRS 3. Under IFRS 11, a joint arrangement is an arrangement in which two or more parties have joint control, and joint control is defined as the contractually agreed sharing of control of an arrangement in which decisions about the relevant activities being the activities that most significantly affect the returns of the investors, require unanimous consent of the parties that share joint control. In effect, joint control means that we have collective control and that the parties that share joint control must act together to direct the activities that significantly affect the returns of the arrangement. No single party has control of the arrangement on its own, and likewise a party with joint control of an arrangement can prevent any other party from controlling the arrangement. It's also important to note that it's not necessary for all parties that are involved with an arrangement to share in joint control for there to be a joint arrangement. If I've got an arrangement in which parties, let's say there's three parties, A, B, and C, A and B collectively have to make decisions, otherwise no decisions can be made. C is an investor in the arrangement but is not involved in the decision making. But in order, as I said a moment ago, in order for any decisions to be made, A and B have to act collectively. That would still make it a joint arrangement. A and B would be the parties that share joint control and would have to account for the investment in terms of IFRS 11. C would be excluded from joint control, but would be part of the arrangement and would have to determine what method of accounting would best apply to that investment. Once we've determined that we have a joint arrangement, we need to differentiate between two types of joint arrangements. IFRS 11 defines a joint operation as a joint arrangement whereby the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities, and they're called joint operators. By contrast, the joint venture is an arrangement whereby the parties that have joint control have rights to the net assets of the arrangement, and these parties are then called joint venturers. The key difference between the two types is what does the investor have rights to? And that will require, in some cases, the use of judgment. In other cases, it might be quite straightforward. One would need to look at the substance of the arrangement to understand, do I have rights to the individual assets and liabilities of the arrangement, or am I simply entitled to a share in the pot at the end of the day once all of the liabilities have been settled, in which case I'd have a joint venture. The distinction between what type of arrangement I have is important because it defines the accounting treatment that applies, and you'll see in a moment that it gives rise to specific accounting issues depending on whether I've got a joint operation or a joint venture. IFRS 11 says that a joint operator must recognize, in addition to its own assets and liabilities, its share of any assets held jointly, any liabilities incurred jointly, any revenue from the sale of output by the joint operation, and any expenses incurred jointly. In doing this, it must also eliminate its own share of any transactions with the joint operation, but the investor would then simply account for this investment on a line-by-line basis, not presenting a different set of financial statements as one would with consolidated financial statements, but simply adding its bits and pieces of its involvement with this joint operation to its own balance sheet. By contrast, because a joint venture results in the venturer having rights to the net assets, another name for net assets is equity, and therefore the appropriate measure of accounting for a joint venture is equity accounting under IAS 28, which is basically accounting for a single line item investment in joint venture, and in accounting for that investment, adjusting the carrying amount of that investment for any changes in the equity that the venturer is entitled to by virtue of the arrangement. Under the previous IAS 31, where proportionate consolidation was an accounting policy choice, IFRS 11 does not permit proportionate consolidation whatsoever in the case of a joint venture. Let's go back to our scenario now, and let's see what the accounting issue is on the basis of the discussion we've just had. If Delta has a 33% in a joint operation, and let's say that by acquiring the additional 33%, they now move into control of that arrangement. So the additional 33% now gives control of Vega to Delta. How should Delta deal with the previously held interest, which by virtue of being a joint operation has been accounted for by bringing in a fraction of various assets and liabilities onto its own balance sheet? The previous two scenarios where we looked at previously held interests involved a single either investment being a financial asset which could then be remeasured, or it involved an investment in an associate which likewise could be remeasured to fair value as part of the acquisition method of accounting upon obtaining control. But in this scenario, the previously held interest was accounted for on a line-by-line basis by accounting for various bits and pieces of assets and liabilities. Let's go back to what IFRS 3 says. In a business combination achieved in stages, the acquirer must remeasure the previously held equity interest in the acquiree at its acquisition date fair value and recognize the resulting gain or loss. And then depending on how the gain or loss would have been dealt with in an outright disposal, account for a profit or loss either profit or loss or in other comprehensive income as the case might be. But there was no previously held equity interest recognized in the books of Delta. That is effectively the issue. The question that was raised, or rather put to the IASB, which resulted in the amendments being made as part of the annual improvements project, was how should a previously held interest in a joint operation be accounted for on the basis that IFRS 3 requires a remeasurement to fair value? The clarification says that when a party to a joint operation obtains control of a joint operation that is a business, that previously held interest in that joint operation must be remeasured to fair value, even though it was not necessarily recognized as an equity interest in the books of the operator. In essence, what would happen is the operator here would, or former operator, which now becomes the acquirer or the parent, the previously held carrying amounts of the assets and liabilities, or the portions of assets and liabilities, would be compared to what that stake was worth, the fair value of what that stake was worth on the acquisition date, with a resulting gain or loss recognized in profit or loss. In this case, because we are dealing with individual bits and pieces, there could be some assets where the gain or loss might have gone to other comprehensive income. For example, if the property, plant and equipment was being revalued through other comprehensive income, but for the most part, most of the gains or losses would probably end up in profit or loss. The amendment to IFRS 3 is effective for periods beginning on or after 1st of January 2019, and earlier application is permitted. If an entity does adopt it early, it must just disclose that fact in the financial statements. We now move across to IFRS 11 on joint arrangements, or rather back to IFRS 11, but now focusing on the specific change that was made, again, as part of the annual improvements project. Once again, let's look at a scenario to understand what the issue at hand was and how the ISB responded by virtue of the amendment that was made. In our scenario that we're looking at now, we see a company called Sigma that owns 5% of Tau. Tau is a trading business jointly controlled by two other parties. During the current year, Sigma purchases an additional 28% of Tau, giving Sigma joint control of Tau. On applying IFRS 11, Sigma classifies Tau as a joint operation. How should one account for this transaction? Let's unpack what's happening over here. If you recall earlier, I said to you that a joint arrangement does not necessarily require that every single party to the arrangement must have shared in the joint control. I gave you an example, a generic example where I said A, B, and C. A and B might share in the joint control. C might be part of the arrangement but be excluded from the decision making and therefore not apply an IFRS 11. And that's effectively what's happening over here. We're told that there was a 5% interest in Tau, and presumably if it becomes a joint operation later, it would have been a joint operation by whichever the other two parties that jointly control this investee. But Sigma was excluded from the joint arrangement and therefore was not applying IFRS 11. Presumably Sigma was probably just accounting for its share of whatever assets it had an interest in. By buying into a joint operation, the question is now, should this previously held interest of 5% be remeasured to fair value on the similar basis that we've described earlier? Now let's take a couple of steps backwards over here. IFRS 11 says if an acquirer has, or if an entity acquires an interest in a joint operation, the entity must account for the acquisition of that joint operation, assuming that the joint operation meets the definition of a business. The new joint operator, or the entity that now obtains joint control of a joint operation, must apply a modified version of IFRS 3. Earlier we described IFRS 3 and said you apply the acquisition method of accounting, and IFRS 3 is written from the perspective of somebody that obtains control of a business, outright control. It might not be a wholly owned entity, but it accounts for it applies to a scenario where you've obtained control. And the accounting under IFRS 3 says you measure 100% of the assets and liabilities of the business, and then you make an adjustment for the non-controlling interest, the portion that doesn't belong to you. This modified version of IFRS 3 that I'm referring to now, in the instance where we obtain joint control of a joint operation, effectively requires you to bring on your share of the assets and liabilities on a line-by-line basis at their fair values, and therefore there's no non-controlling interest to account for. So it's a variation of the standard acquisition method under IFRS 3. Earlier we said that where there's a change in control, we apply the standards that apply IFRS 9, IS 28, and IFRS 11 up to the point of change in control, and then we apply business combination at the point of control. But in the scenario we're looking at now, we've been applying IFRS 11 and there's no change in the control boundary. We can't apply IFRS 3 in its entirety as such because there hasn't been a change in the group parameters, the group boundaries, and as a result of that, we are still sitting in a pre-control environment. And therefore, the question is, how should we deal with the previously held interest of 5%? So, the issue was to clarify how a previously held interest in a joint operation would be dealt with, where the party participated in but did not have joint control and now obtains joint control of the joint operation. The amendment to IFRS 11 says that when a party that participates in but does not have joint control over a joint operation obtains joint control of that joint operation that is a business, it's important that this only applies if the joint operation meets the definition of a business. The party that obtains joint control must not remeasure the interest it previously held in that joint operation. So this is different to the previous scenarios that we looked at, where the previously held interest was remeasured in an effective deemed disposal, which was then replaced with the assets and liabilities that are now brought on the books through the consolidation. And the rationale for that is what the standard said to say was the reason for this is that the transaction has not changed anything in terms of the nature of the group. Previously, the entity was measuring its share of the assets or liabilities, and it continues to measure its share of the assets and liabilities. Granted, there will be a change in the measurement of the assets and liabilities where previously it might have been accounting for a lesser fraction of the same assets and liabilities that it now obtains joint control over. So there could be an adjustment to the individual values, and that comes through in the modified business combination accounting. But there will not be a deemed disposal of the previously held interest. The same assets and liabilities continue to be recognized. Whereas in the earlier example where we said it was formerly an associate or financial asset that now becomes a subsidiary, the old accounting stops and the new accounting takes over, and that's why there was a deemed disposal. So the added paragraph confirms that previously held interests in such a scenario are not remeasured to fair value. And that is the answer to the scenario that I posed a moment ago. The amendment to IFRS 11 comes into effect for periods beginning on or after 1st of January 2019. Once again, earlier application is permitted and any early adoption should be disclosed. We now move to our next amendment as part of the annual improvements for the cycle we're looking at, and that is the amendments made to IS 12 on income taxes. Now, this standard is a standard that has been amended quite frequently in the past. More often than not, the amendments that have occurred in the previous years, we've had some actual amendments to the standard itself, new interpretations applicable to the standard. More often, these types of changes have kind of fallen onto the deferred tax side of accounting for income taxes. But perhaps as a refreshing change over here, we have amendments that are not specifically applicable to deferred tax as such, but apply to income tax in general. More specifically, these amendments apply to income tax consequences of distributions of equity instruments. The issue that was put to the ISB was, where should the tax consequences of financial instruments classified as equity be recognized? IFRS 9 defines dividends as distributions of profits to holders of equity instruments in proportion to their holdings of a particular class of capital. So the issue is around the tax consequences of dividends, essentially. It relates to a situation where in some countries, if an entity pays out a dividend, there may be additional taxes that are payable. The question is, when a company pays out a dividend, should the tax effects or the tax consequences of the dividend be recognized in equity or in profit or loss? Now, prior to this amendment, there was no clear guidance in the standard on how this should be dealt with. And some companies might have felt that because a dividend is reflected as a distribution of equity in the statement of changes in equity and not in the income statement or not in the statement of comprehensive income, that the tax effects should likewise be recognized in the statement of changes in equity. The amendment clarifies that the income tax consequences of dividends must be recognized at the same time as the liability to pay those dividends is recognized. In other words, when the dividend is declared and recognized in the statement of changes in equity, the income tax consequences must likewise be accrued for. But then the corresponding entry, the debit side of the transaction, must be recognized either in profit or loss or other comprehensive income or directly in equity, according to where the entity originally recognized the past transactions or events that generated the distributable profits from which the dividends are being paid. The reason for the tax consequences of the dividends should not affect where the income tax consequences are recognized. In other words, earlier when I said that the view was, well, because the tax arises because of the distribution of the equity, the distribution of the dividend, therefore, and the dividend is recognized in the statement of changes in equity, that should then determine where the income tax effects are recognized. The fact that I'm distributing a dividend is, a dividend is essentially a distribution of past profits as IFRS 9 defines it. And that means that the tax consequences of the dividend are actually the tax consequences of the past profits that gave rise to the dividend. It may be that in some jurisdictions, the tax consequences of dividends might differ depending on whether profits are distributed through a dividend or retained. The fact that there might be differences in tax rates, differences in tax rules applicable to the distributions of the dividends should likewise not affect the recognition of the tax consequences from an IFRS perspective. Let's look at a case study that will illustrate the implications of the amendment to IAS 12. In our scenario, we have a company that owns two buildings. One of the buildings is an investment property accounted for at fair value under IAS 40, which was acquired originally for a purchase price of $50 million. And Elm Street is the administration building of the company, therefore it's owner occupied, and therefore must be accounted for as property, plant, and equipment under IAS 16. The company has elected to account for all properties under IAS 16 using the revaluation model. And once again, we have the original cost information, in this case of $20 million. At 31st of March, both buildings were revalued to their respective values of 70 million and 35 million and sold a day later for the same amount. So presumably there's been no change in value and they were effectively sold at their fair values. So we don't need to worry about any gains or losses arising from the profit or loss on disposal. We're saying that they were sold at fair value. Effectively, what we're saying, though, is that the past revaluation gains, whether it was in the case of the investment property or in the case of the revaluation of the property, plant, and equipment, have now effectively been realized and are now going to be distributed as a dividend. In the jurisdiction in which this company operates, the tax authority allows for the distribution of retained income as dividends, and the company has a positive retained income balance of 30 million before the sale. The dividend tax rate is 10% and there is no capital gains tax on the sale of these buildings. The question that needs to be answered is, how should BRIC account for the above? In effect, what is the journal entry to record the distribution of the dividend? Now let's take a moment to just work through the information that's available to us. We have been told that there is 30 million sitting in retained earnings. And based on the information around Elm Street, the office building, the administration building, we have effectively, we can assume that there is a $15 million balance sitting on the revaluation surplus in equity relating to the past revaluations of the property, plant and equipment. Assuming we're ignoring depreciation and all the rest, the amount of the previous revaluations amounts to about 15 million. Now, just a reminder is to those listening that when you are revaluing property, plants and equipment under IAS 16, the revaluation surplus that arises remains in equity forever. If you were to ever sell the property, you never recycle or reclassify the revaluation surplus back into profit or loss. You're welcome to do a transfer across to retained earnings in the statement of changes in equity, but there is no recycling back into profit or loss. This is important because we're saying that in the Elm Street case, in the scenario we're looking at, there is no there was never an amount recognized in profit or loss in respect of the revaluation of this building. Whereas in the Park Lane case, the investment property, the gains and losses under IAS 40 are recognized in profit or loss. That implies then that they are already included in the 30 million rand, $30 million retained income balance that existed just before the sale of the properties. So when we look at the suggested solution, we have the $30 million retained earnings balance that includes the previously recognized revaluation gains on the investment property. We now have the $15 million amount that was sitting in credit in the revaluation reserve in respect to the office building, which we are now distributing, so we can transfer that out of the revaluation reserve into the retained earnings account in the statement of changes in equity, bringing the total amount of reserves available for distribution to $45 million. If 45 million is now to be distributed, if that's the cash payment that's going to be made, and there's a tax consequence in respect of this, we have to be careful that we don't take 45 million and add 10% on top of that, because then we're going to end up in a negative reserve balance by virtue of the tax effects of the distribution. So we work, if 45 million is the gross amount available for distribution, we need to work backwards by dividing that by 1.1, which gives us a dividend that's been declared of $40.91 million. The tax effects of that being the 10% on the 40.91 gets us back up to the 45 million that is then paid out. In other words, 40.91 is distributed to the shareholders, the dividend amount, and 4.9, whatever the number works out to be in respect of the tax effect is paid over to the tax authorities. However, what's important here, and this is now the effect of the amendment, is that the tax amount, the debit expense element of the tax charge, has to be split between the portion that is recognized in profit or loss, thereby affecting earnings, and the portion that is taken to other comprehensive income, to equity effectively, which relates to the amounts related to the previously amounts recognized as revaluation reserve, likewise in other comprehensive income. So the two debit entries there for tax are the effect of the amendment that we discuss in this webinar, clarifying that the tax effects of a distribution of profits must be recognized in the same place where those profits were previously recognized. Just a word of caution over here. The amendment does not apply to all income tax consequences of all payments on financial instruments classified as equity. It's specifically focused on tax consequences of distributions of profits in respect of equity instruments, in other words, dividends. So if there are any tax consequences that arise from transactions with shares in various jurisdictions might have different tax rules, whereby share buybacks or share issues might have tax consequences, those are not affected by these amendments, and presumably those tax consequences would be recognized directly in equity. Another challenge is to determine whether a dividend is a payment from past profits. And again, that might also require a degree of judgment and interpretation of the tax laws. The ISB has not clarified how to determine whether a payment represents a distribution of profits, that's left up to the tax laws of each jurisdiction. And therefore, you might struggle depending on, I mean, in our simple example, it was quite straightforward. We knew how much of the profits came from which source, and therefore it was easy enough to apportion the tax. In practice, you might need to keep track of these different reserves, of the profits that are recognized in the different reserves, so that when a dividend is declared, it is possible for the company to figure out where the dividend is coming from in order to then apply the effects of the amendment to IAS 12, which requires the tax treatment to be recognized in the same place. This amendment is effective for years beginning on or after 1st of January 2019. Early application is permitted, and once again, if you do early adopt the standard, the amendment, you need to disclose that fact. When you first apply the amendments, you apply them to the income tax consequences of dividends recognized on or after the beginning of the earliest comparative period, meaning that if dividends had been paid out or declared in previous years and they had not, the tax effects had not been accounted for as the amendment requires, a restatement to the comparatives would be required, which could affect earnings numbers disclosed for comparative periods. We now move to our last amendment out of the cycle of the annual improvements project, and that is the amendments to IAS 23 borrowing costs. Unlike our previous discussion on IAS 12, which has been amended frequently in the past, IAS 23 hasn't really been amended much since around 2009, when the last major change to IAS 23 occurred. Let's talk a little bit about what IAS 23 requires. IAS 23 originally allowed for an accounting policy choice in how to deal with borrowing costs and qualifying assets. In its earlier version, IAS 23 basically said an entity may elect to capitalize borrowing costs incurred in relation to qualifying assets, or it may choose to expense all borrowing costs to profit or loss. And various companies had different views on how they wanted to deal with these borrowing costs and would apply the accounting policy accordingly. Around 2009 or thereabouts, IAS 23 was amended to say there's no longer a choice. All borrowing costs on qualifying assets must be capitalized to the cost of the qualifying asset, and all other borrowing costs incurred during the period must be expensed. There's no longer a choice. There's no optionality involved over here. That is what IAS 23 requires. And for the most part, that's how it's been since that change occurred a number of years ago. To understand the implications of this, let's talk very briefly about some of the existing requirements. So a qualifying asset is an asset that necessarily takes a substantial period of time to get ready for its intended use. In essence, what this definition usually captures is assets that, for example, require a period of time to be constructed or developed, if they relate to internal projects, internally generated intangible assets, necessarily suggests that the asset cannot be obtained without going through this period of time before the asset is subsequently ready for its intended use. So it does not apply to scenarios where, for example, an asset is purchased and it takes a period of time to be delivered, and on that basis then it's defined as a qualifying asset. That's not what this is referring to, because presumably if one was to, for example, pay an additional amount or expedite the delivery process, one could get the asset without necessarily having to go through that extended period of time. Whereas when one is building a new building, you cannot get your building ready for use without going through the construction, and that presumably takes a period of time to get ready. Substantial is also not defined. That's also a matter of judgment. Some entities define this as anything over 12 months. Others look at a period over 6 months. What's important is whichever way you go and however you interpret the term substantial, it should be applied consistently to all similar types of assets. So you can't be in a situation where, for example, you say that we believe 9 months is a substantial period of time for one asset, but then we've got an asset that takes 12 months to get ready, and we say that that's not a qualifying asset. Again, one must apply the principles consistently. Borrowing costs is another important term because that determines what gets capitalized. Borrowing costs is any costs connected with the borrowing of funds, and it will include things like your interest expense calculated using the effective interest method, finance charges in respect to finance leases, exchange differences only to the extent that they are regarded as an adjustment to interest costs. Be careful here, ladies and gentlemen, that you don't end up in a situation where you include exchange differences on translation of outstanding balances of foreign creditors, because those are not an adjustment to interest costs. And also, borrowing costs also include an amortization of ancillary costs incurred in connection with borrowings, but does not include actual or imputed cost of equity capital. So this must typically be borrowings in the form of liabilities and the costs associated with those. As I mentioned at the start of this section of this webinar, there's no longer a choice under IAS 23. All borrowing costs directly attributable to the construction, production, or acquisition of a qualifying asset must be capitalized as part of the cost of the asset, and the measurement of the amount of borrowing costs to be capitalized depends on the nature of the funding used. IAS 23 differentiates between specifically borrowed funds and generally borrowed funds. And these types of funds, or depending on what type of funds have been used, there's a different methodology that's applied in terms of calculating the amount of the borrowing costs that need to be added to the cost of the qualifying asset. With specifically borrowed funds, these are funds that have been borrowed specifically for the construction of this particular qualifying asset, and therefore it's relatively straightforward to link the borrowing costs in respect to the funding to the acquisition of the individual asset. In other words, for every currency unit spent on the construction or acquisition of the qualifying asset, we can directly relate the borrowing cost amounts, the interest amounts to these, and there's no need to calculate different rates or different methods of allocating the borrowing cost to these qualifying assets. The methodology for specifically borrowed funds, it says that you capitalize the actual borrowing costs incurred on these funds, less any investment income earned on the temporary investment of those funds, which is perhaps more of an issue where you have obtained the funding up front, invested the funds, earning interest temporarily until the funds are called upon to spend on the construction of the qualifying asset, and therefore the effect is that you capitalize only the net interest, the net interest between the interest paid on the loan and the interest earned on the positive balance in the bank account. This is not an issue where you have an access type facility where you only draw down on the funds as and when you need them, in which case then you would only capitalize the actual interest incurred on the funds drawn down on. When funds are borrowed generally, it becomes a little bit more complicated. Generally borrowed funds refers to a situation where an entity has different sources of funding available from which it is going to fund the acquisition or construction or development of the qualifying asset. An entity, for example, might have various loans, various borrowings in the form of overdrafts, loans advanced, issues of debentures or preference shares, or various ways in which it has now gathered the funds necessary to construct the asset. The challenge where this is the case is that it becomes difficult and often impossible to allocate how much, or rather from which source of funding the expenditure on the qualifying asset arises. So as money is being spent on developing the asset, let's say the asset costs $100. It's difficult to say for each dollar spent whether it's coming out of the bank overdraft, out of the loan advanced, out of the mortgage, out of the debentures issued, or the preference shares that were issued. So to overcome this hurdle, IAS 23 has the following methodology in place for generally borrowed funds. Essentially, a capitalization rate is calculated, which is made up of the weighted average interest rates on the various sources of funding. So a single capitalization rate is then calculated for the entire pool of funding, and that capitalization rate is then applied to the expenditures on the asset as and when the expenditure occurs. That'll give rise to an amount that now forms part of the cost of the asset. And that amount capitalized through this process is compared to the actual borrowing costs incurred from the various sources of funding for the period in question. And then IAS 23 requires capitalization of the lesser of the two amounts to avoid a situation where an entity perhaps over-capitalizes by virtue of the expenditure not having necessarily been uniform during the period, or to overcome other challenges from this methodology. Capitalization of borrowing costs commences when expenditure is being incurred on the qualifying asset and stops when substantially all of the activities necessary to get the asset ready for its intended use or sale are completed. Outside of these two parameters, or outside of these 2 points, an entity may be incurring borrowing costs on the exact same funding that's the subject of the borrowing costs that are calculated within this period, but outside of these 2 points in time, any borrowing costs incurred are then expensed. So this defines the period for which the borrowing costs are capitalized, and outside of this, all borrowing costs are expensed. So that's the background to IAS 23 up till the present date, and nothing much has changed in respect of that for a number of years. But an issue was brought to the IASB's attention regarding how to deal with borrowing costs that were made specifically to obtain a qualifying asset in general borrowings when that qualifying asset is ready for its intended use or resale or sale. In essence, you've got a situation where a company might have lots of different qualifying assets, some in which specifically borrowed funds are in use, and in other cases where generally borrowed funds are in use. And what happens at the point where an asset that has been funded through specific borrowings is now ready? Should the outstanding funding that was used for that asset form part of the generally borrowed funds for the asset that continues to be under construction or development? The clarification of the wording that's been made as part of the annual improvements project confirms that to the extent that an entity borrows funds generally and uses them for the purpose of obtaining a qualifying asset, the entity shall determine the amount of borrowing costs eligible for capitalization by applying a capitalization rate to the expenditures on that asset. That's always been the case. The capitalization rate shall be the weighted average of the borrowing costs applicable to all borrowings of the entity that are outstanding during the period. That's the amendment that's now been clarified. And the effect of that is that when a qualifying asset is ready for its intended use or sale, and some of the specific borrowing related to that qualifying asset remains outstanding at that point, that formerly specific borrowing now forms part of the funds that an entity borrows generally. Let's look at an example that will illustrate the application of this amendment. In our example, we have a company that's constructing 2 qualifying assets, a new factory and a new office park, both of which are qualifying assets and both of which started construction on 1st of January for the year under review. In the case of the factory, $1 million was borrowed specifically for the construction of the factory, so there's our clue that we're using the specifically borrowed requirements of IAS 23. The interest rate on the debt is 10% per annum, and the full $1 million was drawn down on the 1st of January. The amounts were paid out, in other words, the expenditure on the qualifying asset occurred with a payment of $600,000 on the 1st of January and $400,000 on the 1st of April, with construction completing on the 31st of October. The company earns 5% on its current account. In the case of the office park, we have an amount of $450,000 during the year ending 31 December. The amounts were paid in tranches, 1st of March 150,000, 1st of September 200,000, and 1st of December 100,000. The borrowings that made up that funded the construction of the office park comprised a bank overdraft of $100,000 at 15% per annum, a long-term loan at $1,525,000 at 7%, and debentures issued of $1 million at 12%. And we're reminded that the loan to fund the factory was still outstanding at 31 December, meaning that even though construction on the factory ended on 31 October, the loan remained outstanding and presumably was attracting interest. Assume that the year-end balances on the interest-bearing borrowings were stable during the year, and so for our purposes, just to keep the example straightforward, that there were no repayments affecting the amount of interest, and the construction of the office park is still incomplete at year-end. To illustrate the issue that arises out of the scenario, we have two qualifying assets, one using specific borrowings, and under IAS 23 we take the actual interest paid less interest received for the period under construction, whereas in the case of the office park, because we've got generally borrowed funds, we calculate a capitalization rate made up of the weighted average interest amounts of the various sources of funding, being the overdraft, the long-term loan, and the debentures for the period under construction. At the point where the factory is now ready for use, the office is still outstanding, the office park is still under construction. So we still need to capitalize borrowing costs on the office park throughout the full period of time. But in the case of the factory, we stop capitalizing the borrowing costs at the point where the asset is ready for its intended use. The amendment to IAS 23 effectively then brings in the specifically borrowed funds for the factory into the pool of funds available from the 1st of November onwards, which means that from the 1st of November we now need to calculate a new weighted average capitalization rate made up of the overdraft, long-term loan, debentures, and the loan that was used for the factory. Quantifying these amounts using the principles of IAS 23. In the case of the factory, we have the cost of the specific borrowings being the $1 million multiplied by 10% for the full year, weighted for the period of time being the 10 months out of the year that it was under construction, less the reinvested funds being the $400,000 that was only called upon from the 1st of March, which earned interest at 5% for 3 months. And the net amount to be capitalized for the factory is $78,333. In the case of the office, for the period 1st of January to 31st of October, our weighted average capitalization rate is made up of the bank overdraft, the long-term loan, and the debentures, giving us a weighted average interest rate of 9.21%. We apply that to the payments as and when the expenditure occurs. So in the case of the payment made on the the first payment, the payment of $150,000, we weight that by 8 months out of 12, and the second payment by 2 months out of 12, giving us $133,333, on which we apply the capitalization rate of 9.21%, giving us an amount to be capitalized for the period up to 31 October of $12,279. For the period 1st of November to 31 December, we've changed our capitalization rate, which now brings in the additional loan that was previously used for the factory, and that changes our capitalization rate to 9.43. On that, we apply on the payments weighted by the period of a number of months in question, giving us weighted borrowings of 66,666, and applying the new capitalization rate to that gives us interest of 6,287 to be capitalized on the office park. In total, the total amount capitalized for both the factory and the office park is made up of the 78,333 from the factory, plus $18,566 on the office park for the respective periods of time where we had different capitalization rates, giving us a total interest amount of $96,899 for the of borrowing costs to be capitalized under IAS 23. This amendment is also effective for periods beginning on or after 1st of January 2019. Once again, early application is permitted, and if you do early adopt it, just disclose that fact. That concludes the annual improvements project for the 2015 to 2017 cycle. We've covered the amendments to IFRS 3 on business combinations and IFRS 11 on joint arrangements. Both of those amendments dealing with slightly different issues, dealing with previously held interests in joint operations. IAS 12 on income taxes, dealing with income tax consequences of payments of financial instruments classified as equity, specifically payments of or distributions of profits, and IAS 23 on borrowing costs, clarifying what is meant by borrowing costs eligible for capitalization where generally borrowed funds are used. If you have any questions regarding the topics covered by this webinar, please submit them and we will answer them for you. Thank you for tuning in. Till next time, take care.